Welcome back to our business planning series. We're continuing on with our operations plans. Today, we are going to talk all about financials, what you need to keep in mind financially when you are starting up your business. Welcome back to The Financial Dad, the show where we ask our real dad, a certified financial planner, everything you need to know about starting a business. If you never learned it at school or at home, don't worry, because now you've got a financial dad too. Dad, I'm going to let you take it away. What are we thinking about?
Yeah, a lot. So if for those who saw our last video on operations, let's start there. We took all the aspects of how we think we're going to operate the business day to day, and we spec'd out the costs of them. And we're going to start to put all that into a spreadsheet. Now, so the financial aspects here, there are several, I would say. The building a budget and a cash flow analysis for the business. How will you raise money for the business? And then finally, how will you operate the ongoing financial management? In other words, accounting and bookkeeping, basically.
What is a cash flow analysis break down layman's terms for us really quickly?
Yeah, sure. So what it would be is an estimate of your expenses, literally from the day you start buying stuff, for the business to be ready to operate it, including all of the startup costs. In the case of our brew shop, we're going to outfit the space, and it's going to have neat, we want it to have a cool vibe and all that kind of thing. So what is our budget for all the things we're going to purchase that make that cool vibe look the way that we want it to look when people, come in? Add to that, like lighting and sound, for example, we talked about. With a coffee shop, you're going to have coffee smells, but another business might, a spa, you might want to have lavender smell, a diffuser when someone walks in the door, so that they're immediately presented with a different atmosphere, a different place to enjoy. So all of those costs, the startup, and then the operating costs. And we're still going to talk about personnel, but you have to build in personnel costs for your staffing that you're going to have. You have to put those month by month by month out for at least 12 months. And then against that, you're going to put projections of potential revenue. This is where it is very easy to be way overconfident in how well things will go.
I was going to say the same thing. Like that has to be okay. I'm going to guess that we're going to bring in 20,000 a month in the Brewzone. Like, how do you even begin to project that number?
Okay, well, take the main thing you think you're going to sell with Brewzone, coffee cup of coffee, right? We're going to price it at $5. How many a day do we think we will do? We're going to have some pastries. How many a day do we think we'll do of those? Whatever it is, we're going to have a variety of that available. And how much will they cost us to purchase? The supplies of it go on the expense side, and then the revenue goes on the revenue side. So you make an estimate based on that. We're hoping to have at least 100 people a day come through. So let's say 70 coffees at $5 plus, another, I don't know, $200, $300 of other stuff. Maybe it's $1,000 a day we're hoping to bring in.
Mm-hmm.
Hopefully it's more than that, because it would be, I don't know that you could make enough money, to support 4 employees, even if they're part-time or something. But whatever that is. So that's how you do it. You just break it down into the smallest component parts and build up from there. But this is where you can be very overly optimistic. And every time that I talk to people now about business, I joke with them. The one thing I have found in all of my time doing this is that the expenses are always a little more than you expect, and the money always comes a little slower than you expect. So, be conservative with the numbers, because the difference here between right and wrong can mean running out of money in 8 months or not. That's how important this is. So, so you're going to build the cash flow analysis. You'll take the revenue projections, subtract from that your business expenses for a month, and you'll get your projected cash flow or profit for that month. It's a cash flow profit, basically. It doesn't involve things like depreciation of assets, which are non-cash flow items. Try to keep it simple, right? So just straight cash flow. And then what you really want to do is you kind of want to start on the left-hand side or the beginning of your spreadsheet with a cash amount. Let's say it's $50,000. This is my estimate in my mind of what it's going to take to get this off the ground. So each month, if there is no profit, if it's a negative, you're going to subtract that amount from the $50,000 and project your balance at that point there. And if it's a projected profit, it'll get increased and you'll project your increased bank account value there. So that way you have a running total of that bank balance that you expect. And, you can look to see, geez, does it go negative? That's where I'd be running out of cash as a business, right? So that will tell you, even if you're being conservative with your assumptions, maybe you don't have enough startup capital to do what you're trying to do.
Can we pause on the startup capital? Like, I'm even thinking, how on earth do you even have the money to start this? For our example with Brewzone, the person who is running this business or starting the business, they worked at a coffee shop prior to this. So are they
Yeah.
going to be thinking about, and anyone listening, are they thinking about a small business loan? Did they save up a bunch of money and they're just going to self-fund it? Are they going to, try to get angel investors? Are they doing a Kickstarter campaign?
So we have to make estimates of what we will need as startup capital. So that's to outfit the whole thing. Buy equipment. By the way, leasing equipment generally is better at the beginning than buying equipment because it takes much less of a capital outlay. So what will it take us to just get to the point where we can open the doors and start selling our product? Okay. So that's one amount that we have to estimate. And then the other one is what we've been talking about more with the operations side. What will it cost us to operate this business on a daily basis for supplies, for personnel, for lights, electric, rent, all of that going forward? So eventually, that cash flow analysis is going to show us how much money we need to get to profitability and be, comfortable, sustainable. Then the question is going to be, whatever that dollar amount is that, needs to be in cash before we kind of get going here, how will we get that money? So there are a series of different ways of doing this. Many people self-fund a business. So for example, I have savings that are not inside a retirement plan that I can access, and I'm just going to run through that or use half of that, let's say, as my startup capital, as the amount of money that I need. There's some people have a profit sharing plan where they work. You can actually borrow up to about $50,000 of that amount, pay it back over 5 years, and you can access cash that way. A lot of people don't know about that one, so I'm putting it out there. You can get a home equity loan against your house. So there are several ways. The one way you don't want to do it is credit cards. You don't want to, get big credit lines and write checks and pay 28% interest. That's a bad way to get, to self-finance something. But those first few ways would be major ways that people would self-finance. The next level of it would be, let's call it friends and family, angel investors. You could use that term, but these are people who are favorable to us for some reason and know us personally. And we hope that their confidence in us and our confidence in what we're going to do will be strong enough that they would help put in some of the money. By the way, there are two ways to put money into a business, generally speaking. One is to buy equity, ownership. Now, most entrepreneurs want to maintain full ownership or at minimum full control, more than 50% of the stock of the company, so that they don't get fired someday. You know what I mean? And nobody else can tell them how to run the business. So equity is usually the way you're not trying to do it. You want to try to get away without doing that. So the second way is by means of a loan from friends or family. A loan typically means it has to be paid back over time. Might be a 5-year loan or an 8-year loan, something like that. But that means you need cash flow from the business to pay interest and or principal on the loan. Whereas if you do equity, there's no real expectation that there will be income from the business anytime soon for an equity investor. So, friends and family. The next level might be investors, but people who are not friends and family. You're going to have to provide a really solid business plan. You're going to have had experience in this business before, generally speaking, before somebody's going to either invest with you or loan money to you for that. And it's going to be a bit of a rougher road to get there. The next level would be bank loans or government loans or grants for that matter. Difference between a loan and a grant. A grant is just a giveaway of money to you. Take the money and go make the business. A loan, again, is something that has to be paid back. So a loan from a bank, a loan from the Small Business Administration or SBA, or any other small business governmental entity. It's going to be a loan. There are going to be strict things that have to be met to keep the loan from going into default. Those things are called covenants usually. And, again, you're going to have to pay that loan back over time. So we'll put a crimp into the cash flow. And also there you're going to need a very solid, well-prepared business plan also. It really, in these ways of raising money that don't involve friends and family, you have to present yourself very professionally. It has to be very detailed, well thought out. It's got to be a well done job if you're going to really try to go for money from third parties like that. I mean, there are other ways. You can go to a broker-dealer company like my company, and you can say, "Hey, can you guys raise $1 million for me to start up a Brewzone, or to start franchising Brewzones or something like that?" And a broker-dealer might be willing to do that. They might be willing to work with you on creating a structure and a way, like a limited partnership, for example, a way for people to invest in it, and then they would go to the marketplace and sell that to their investors. But their investors typically are going to be getting some kind of equity. It's not usually done for loans really so much. The final way of doing it is really the crowd approach, crowdfunding approach. You put something out there and you just look to raise money from people. This is a little bit different because it's a business. And if I'm giving money in a crowdfunding approach to something that is a for-profit business, well, what am I getting for that? Am I getting ownership for that? Is it a loan for that? Am I just giving you a grant to help you start up? Why would I do it? What is my motivation or incentive to get involved in this? It's one thing if there's something altruistic to it. We're trying to raise money for X, Y, and Z and blah, blah, blah. But if people are giving money to a for-profit business, they generally are going to be expecting something back as a result of that. So those are sort of your options on finding that amount of money that is needed, to, let's call it, get through that first year with a positive bank balance projected. A lot of people would go to the bank and start there, especially local types of banks. The challenge with banks is that they want to know that there is some collateral, there's some equipment or there's some something that they can go take and sell to repay part of the loan, at least in the event you don't pay it back. So that would be called a secured loan. An unsecured loan would mean there's no collateral. The person who makes the loan is just out of luck if the company goes bankrupt and declares bankruptcy, and there's not going to be anything they can really, they're not first in line anyway to go after something from the business. Yeah, so I mean, that's really, the financing part of it. The financials and bookkeeping part of it, you're going to need a system for that. You're going to need it to be tied. Ideally, it would be tied into your merchant system so that transactions are captured electronically and you can account for everything electronically rather than, a lot of reconciling work by hand and things like that are a pain in the neck to do. So that's important also. The cash flow analysis and budgeting, the raising of capital, and then the financial management piece. All of that falls under financial operations in getting a business as a startup, getting it going.
No big deal. Just a couple things to think about.
Uh, I hope that when people are done watching this, they don't change their minds about starting up a business.
I think it's actually so helpful though, because as we've mentioned before on this channel and in conversations, social media makes things seem really simple these days because there's less barrier to entry for some of these businesses that can be online. But no one is thinking about these things, and I love learning because there is so much more for me to learn too. So I think this has been really helpful. We've talked about, the operations piece and the money that it will take to actually operate it, the equipment. We've talked about how to fund the business. We've talked about the accounting and organization and management of the business from a financial perspective. So this has been fantastic. The next video, we're going to talk a little bit more about the who. So who's actually going to help you run this business? Who's going to make it happen? The personnel, the staff, the angels. And if you are loving this video series, please like, subscribe, and comment to the channel. Every single person who watches this allows us to continue making more of these videos for you. So thank you so much for being here today, and we'll catch you soon.